Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
What if money is not a thing but a story we collectively agree to believe? Entire civilizations have risen and collapsed based on that fragile shared fiction. Gold once anchored that belief with weight, scarcity, and physical certainty. But certainty itself would become the first casualty of financial evolution. For thousands of years, gold appeared immune to human manipulation and political whim. It did not rust, decay, or multiply at the command of kings. Its rarity imposed discipline on rulers and constraints on reckless expansion. That constraint, however, would eventually collide with modern economic ambition. As trade expanded, physical metal became increasingly inconvenient for growing economies. Transporting large quantities of gold was slow, costly, and dangerously impractical. Banks emerged as custodians, promising safety while issuing paper claims against reserves. Trust quietly began migrating from metal itself to financial intermediaries. Paper money introduced a powerful abstraction that reshaped economic behavior. Value no longer required physical possession but confidence in institutional credibility. As long as redemption remained possible, the illusion felt stable and rational. Yet stability built on belief alone contains vulnerabilities invisible during prosperity. Periodic banking panics exposed the structural weakness beneath this monetary arrangement. When fear spread, redemption demands surged beyond what vaults could satisfy simultaneously. Even solvent institutions collapsed under the mathematics of collective withdrawal. Confidence, once fractured, proved more volatile than any commodity price. Policymakers sought a solution capable of containing these recurrent financial crises. Centralization appeared to offer coordination, elasticity, and emergency liquidity in turmoil. The creation of the Federal Reserve marked a turning point in monetary authority. Power over currency gradually consolidated into a single systemic actor. The new framework promised stability by managing reserves and smoothing credit cycles. Interest rates became policy tools rather than market outcomes alone. Money supply adjustments aimed to counter contractions and prevent destructive deflationary spirals. Economic management replaced passive adherence to metallic constraints. Early successes encouraged confidence in active intervention and macroeconomic steering. Lower borrowing costs stimulated investment, consumption, and speculative enthusiasm alike. Asset prices surged, reinforcing optimism and masking accumulating systemic imbalances. Booms fed narratives of mastery over the old limitations of scarcity, yet expansions fueled by credit often carry seeds of their own reversal. Excess leverage magnifies gains while quietly amplifying fragility beneath surface prosperity. When expectations shift, liquidity evaporates faster than confidence can be restored. Financial systems built on psychology can unwind with brutal speed. The collapse that followed revealed the scale of interconnected economic vulnerability. Bank failures cascaded, contracting money supply and intensifying real economic devastation. Deflation increased debt burdens, accelerating insolvency across households and institutions. What seemed like wealth dissolved into balance sheet arithmetic and fear. Authorities responded with unprecedented measures to reflate demand and restore stability. Liquidity injections and policy innovations redefined the boundaries of central banking responsibility. The crisis reshaped doctrines, embedding intervention as a permanent feature of modern finance. Money's meaning drifted further from metal toward policy-driven abstraction. Decades later, similar patterns echo through bubbles, crashes, and emergency rescues. Credit expansion, optimism, correction, and intervention repeat with unsettling familiarity. Technologies change, markets evolve, but human behavior exhibits remarkable continuity. Belief, not mathematics alone, remains the ultimate driver of financial cycles. First, money functions because societies accept shared narratives of value and stability. Second, institutions managing that belief wield influence extending far beyond technical policy. Third, confidence can sustain systems longer than fundamentals might logically justify. Fragility often accumulates precisely when risks appear most distant and abstract. The enduring question is not whether belief shapes money, but how belief shifts. History suggests transitions occur gradually, then suddenly, under pressure and necessity. Understanding these dynamics offers perspective in an era of digital and synthetic assets. If money is a story, the next chapter is already being written.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.